Welcome, and thank you for being with us to talk through bonus depreciation for commercial real estate. And my name is Jerry Frank, and I am with STRATAFOLIO. And STRATAFOLIO is a web-based software solution to help commercial real estate owners help with financial management, asset management, lease management, and investor management. A big part of what we do is help owners with driving down costs through automation and efficiency, but it really shouldn't end there. So we're always looking for opportunities to help our customers positively impact their bottom line. And seeing the bottom line helps you make decisions as owners about strategies around taxes. We're happy to have Tyler Dingle with us today. Tyler is a Senior Vice President at CBRE Hubbell Commercial, and he's recognized as a leading broker in retail, office, and investment markets. He's based out of Des Moines, Iowa, and he specializes in real estate investments. Over the past 3 years, his team has completed over 300 transactions with a value of over $650 million. Welcome, Tyler.
Thank you. Glad to be here.
So today's format is actually going to be about 10 to 15 minutes of discussion, followed by questions from people in the audience. So we're going to just start with the big question. Tell us what bonus depreciation is.
Yes, that's our topic today. That's I deal in bonus depreciation a lot, kind of in my line of work. But as you kind of mentioned in your intro, is investors are always looking at how do I maximize my dollar at the end of the day, that bottom line number in the dollars in my pocket. Mm-hmm. Historic depreciation on a residential property is a 27.5-year schedule. On a commercial property, it's a 39-year schedule. Bonus depreciation essentially is a tool that allows you to accelerate that depreciation. So rather than taking that depreciation over a 39-year schedule, you're able to accelerate that and take that into the first year of ownership. So what that does for an investor is it puts a lot more capital in their pockets day one, that they're not having to wait and get that in smaller chunks over the course of 39 years.
Mm-hmm. That's a really nice tool. And I realize that this was just about ready to go away, but you want to talk a little bit about how the Tax Cuts and Jobs Act of 2017 changed the rules around bonus depreciation?
Yeah, so it was a pretty major change. In 2017, the Trump administration came out with the Tax and Jobs Act, which historically the bonus depreciation was set up at a 50% level. So you could depreciate 1/2 of the value of the improvements in the first year, and then you took the remaining 50% over the remaining 38 years of that asset's life cycle. With the change in 2017, there was two big things that came out of that for real estate owners. The first being is it went from 50% bonus to 100% bonus depreciation. So that was obviously a major change from a tax perspective. The other aspect of it that was very important for owners as well is it changed it from having to be a new asset or a new construction, new build, new project, to where it could be an existing asset as long as it was new to that taxpayer. So historically, when I was selling assets that would qualify for this depreciation, it had to be a brand new store or brand new property. Now we're able to trade those properties on the secondary market, and they're still able to qualify for the 100% bonus.
Okay. And originally, bonus depreciation was going to expire when? Do you know?
Boy, I want to say it was 21. I think it was 21, the original expiration. And so the Tax and Jobs Act not only changed it to 100% and allowed it for a secondary trade market, but extended that term. So now it's set to, rather than just expire at the end of 2022, it's going to start a step down approach. So in 2023, it goes to 80%, 2024, it goes to 60%, 2025 to 40%, 26, 20%, and then it will completely phase out to your standard depreciation schedule is how the legislature looks at it today. Now, whether that changes down the road, whether that gets extended, it has done that several times in the past, but All we can do as investors and owners and brokers is look at what the law states today and how that's going to affect your portfolio, your real estate here in the short term.
Okay. And the first step down starts at what year?
2023.
Okay. All right. So everybody's got a couple years yet. So
That's right.
when you talk about qualified property, do you want to talk a little bit more about what that really is? And you alluded to it a little bit.
Yeah. So the big picture, I guess, on that qualified property would be essentially there's some nuances in this, but essentially any asset that has a 20-year depreciable life or less. So, historically, people would look at things like concrete or furniture, fixtures, equipment, items like that, machinery, items that have a depreciation life of 20 years or less qualify for the 100% depreciation. Now, there's a number of things that people have, when that tax code is written, obviously everybody's looking at how do I work the system to make that benefit my personal, scenario. So one thing that really gained traction over the years is looking at taking an asset. So if you were to buy an apartment complex and doing a full on research on what items within that complex can I qualify for bonus depreciation, what items within there have a depreciable life of less than 20 years, your carpet, your again, I mentioned fixtures, your appliances, items like that how do we, they use a term called cost segregation analysis, but how do we take a building, so you purchase a apartment complex for $10 million, can we figure out how to put $5 million into buckets that qualify for a 20-year less life? $5 million is obviously your core real estate that has that longer life cycle. But if you can get that 100% bonus on $5 million of the $10 million purchase, that has a substantial impact on the amount of dollars that you're able to keep in your pocket at the end of the day.
Right. Yeah. Yeah. Really interesting. Now, I know there are some specific questions around convenience store owners and how they've benefited from from bonus depreciation. And actually, we have someone actually asking the same question about that right now, about they've seen the flyers that you have around Come and Go because they're on the mailing list. So can you talk a little bit more about convenience stores and how this applies?
Yeah, and so that's an area that I do a substantial amount of work in. Come and Go is a great client of mine. I've done real estate with them for about 15 years, and this is a provision within that tax code that really benefits not only convenience store operators, but also folks that want to invest and own a convenience store, but not necessarily operate it. So, for example, using Come and Go. They typically don't own any of their real estate that the stores sit on. What they would typically do is they'll go find a site, a piece of real estate that is well suited for a convenience store. They will go in and purchase the site. They self-develop their sites. They will build the store, get it open and operating, and then engage my team to then sell that asset to an investor. In turn, Come and Go signs a 20-year triple net lease with that investor. So the investor owns the real estate, Come and Go operates the business, and they're essentially a landlord to Come and Go. Come and Go pays them rent the first of every month, and they get the rental income, and they also benefit where that depreciation comes in. They also benefit from that bonus depreciation. What's unique about convenience stores is they actually qualify with a 15-year life schedule. There's a couple of metrics within the tax code that allow them to do that, and they have to hit one of those three items. But the one that most of them qualify in is if over 50% of their sales from that store come from petroleum-based products, i.e. fuel, they qualify under the petroleum section of the tax code as having a 15-year depreciable life. So again, having that 15-year life then qualifies them for the 100% bonus. So again, an example, if you had a come and go store, convenience store that you purchased for $5 million,
Mm-hmm.
you could go kind of break that down between land and improvements and say you have $1 million of land value and $4 million of improvement value. That would allow you to have a $4 million write-off in the first year of ownership, which again, if you're looking at paying tax on $4 million, and all of a sudden you're able to purchase a convenience store that wipes out that tax burden, that's a pretty substantial tool.
Yeah. Yeah. So I'm guessing that people seek you out kind of at the beginning of the year then, or the end of the previous year to do this kind of thing.
Yeah, I would say my busiest month of the year is always December, and my busiest week of the year is typically the last week of the year. We sell stores throughout the year. Part of that has to do with come and go's construction process. Typically they're breaking ground on new stores in the spring, and so I typically have more product to sell at the end of the year. But it's also the time where investors and business owners get to the end of the year and they start to see what that tax bill is going to look like, and they start to look for ways of how do I shield myself a little bit from this tax burden I'm going to face. And that's when again we start to get a stronger interest and more groups that are looking at the convenience stores as a way to help shield some of that tax burden. And again, the same would go for other property types where you're able to use that cost segregation to get the largest amount of write-off you can.
Right. So how does bonus depreciation differ from Section 179?
That's a great question. They act very similar. The way that they're set up, they're set up to kind of achieve the same thing. The difference with the 179 is there are limitations on that. I believe the amount is like $1,150,000. I believe it is the current for 2021. That threshold that's the maximum deduction that you can take through Section 179. Obviously, with bonus, there is no limit. You can buy multiple stores, you can buy multiple assets, you can shield more of that or take more of that depreciation than you would in a typical Section 179. The other aspect of it is 179, the write-off on that or depreciation on that is specific to your taxable income for the year. So if you had $1 million of income and you had let's do a different scenario because that gets too close to the threshold. Let's say you had $200,000 of taxable income.
Okay.
And through Section 179, you have $1,150,000 that you can write off. You're only able to depreciate the full value of your taxable income. So your depreciation stops at $200,000. The balance of that amount has to be carried over a standard depreciable life. Okay. Now, with the bonus depreciation aspect, if you have that same $200,000 income level and you have $1 million of write-off, rather than taking that $800,000 over a standard depreciation schedule, you simply carry it forward into the next year, and you can use it in full in the next year or until it's fully used up. You can carry that paper loss forward for up to 10 years.
Okay.
I should have made this disclaimer before we started. I do a lot of work in around depreciation schedules and how it affects incomes and things like that, but I am not an accountant, and I always advise every client to certainly talk to their accountant before they make any final decisions. But I've answered a lot of questions and been through this process quite a few times. So
yeah, well, and a big part of what you're doing when you're trying to help someone get into a property is you are looking at not only the income for this year, but the income for out years. And so you are very close to the details around this to make it happen and happen in the right way.
Yeah, absolutely. And it's it's kind of one of those time value of money things. You could look at it, if you had a standard 15-year life schedule, you may say, well, why would I take it all now? That's just going to increase my tax burden down the road. Which is a fair statement. Maybe you'd prefer to have it over 15 years. Majority of my clients look at it like, hey, if I can erase my tax um, consequence today
Mhm.
and take that money now, reinvest it,
Right.
I'm gonna basically make a return on borrowed money in a sense.
Mhm.
Now, as we all know, with depreciation, with taxes, all those things, it's not something that you're getting rid of forever, but
Right.
it's something that you're able to defer. It's the same things people do with a 1031 exchange, is you're able to defer that tax to a
Mhm.
later date, and essentially you're getting that tax-free money, or that interest-free money up front that you're able to either invest back in your business or in other assets or things like that, that you can make that money work for you
Mhm.
while you have that asset under control. Now, down the road, at some point, you decide, hey, I want to sell this asset. Maybe it's 10 years down the road. There is a recapture. So you do have to recapture that depreciation at the time of sale. And then you have other decisions at that point, whether you want a 1031, whether you want to pay the gains at that point. There's a number of things that you can do at that point. But again, typically what we see is most investors, if they can defer that pain for another day and utilize that capital in their business or in their investments in the short term, that's their preference.
And so they don't have to take bonus depreciation at all, but they really only have that first year to do it, correct?
Yeah, so you have to take it in the first year that you place the asset into service. You can elect not to take it. Again, for the convenience store example, those are 15-year schedules. So you may say, you know what, I want a straight line 15-year depreciation schedule, and I'm just going to take it over 15 years. Again, the vast majority will say, even if I don't need it all today, I'm going to take the bonus depreciation in the first year, and I'll carry forward what I don't use this year into year 2, 3, 4, 5, 6, however long it takes for them to fully utilize that.
Oh,
They can go that route on it. So that's one of the major benefits of it. So
so really, if they're thinking about in the situation of come and go or some of these properties where they have 20-year leases, they very likely have the intent of keeping it for a long period of time. So there's a good chance it makes sense to take that.
yeah, most of my clients look at buying and holding. They're very stable asset, strong tenant, stable incomes. The one thing that people really appreciate is they're really headache free. Um, the tenant takes care of all of the lawn, the snow, the taxes, the insurance, all those things that can be a headache for a real estate investor. All those things are taken care of by the tenant. So they literally get a check. Actually, they don't even get a check anymore. It's all ACH, but they get the rents wired to their bank account the first of every month, and they don't have to think about it. So it becomes a nice vehicle for them, income stream that they don't have to think about, and still reap the benefits from.
Right.
But we also have groups that will, for example, with these come and goes, there's a 5-year a rent bump every 5 years of a lease. So some owners may hold it for 5 years, wait for that rent to bump, and
Mhm.
then turn around and sell it at that higher with a higher rent number in place at a similar or lower cap rate a lot of the times, and
Mhm.
able to maximize their gain. But again, at that 5th year, you are going to have the recapture of the depreciation that you took.
Right.
That doesn't mean that you have to pay that tax at that point, because you have options for exchange and things like that. But it is a deferral of tax, not an elimination of it.
Right. Right. Well, and I'm guessing definitely what we have found now is that convenience stores have been kind of pandemic proof. So it is probably a good investment right now. And I know there are a number of other areas out there right now, totally different topic, a different day. But this does seem to fall into one of those areas that has done well during during the pandemic.
Yeah. So in our business, we the investment side of our world really kind of held our team up over the last year. Leases were down quite a bit. Number of leases signed, and obviously the length of leases had pulled back a little bit. People were unsure what the future might look like, and wanted a little more certainty and before entering into something more long term. But the shining light over the last year has been these recession resistant, or these, a lot of us coined essential servicers. and folks are wanting to invest in groups that they feel are essential servicers. And regardless of the environment we're in, those groups there's a need, a requirement for them. Whether that be pharmacies, grocery stores, convenience stores, all of those groups fall into that essential service retail sector. So convenience stores obviously fall into that as well. I think if you follow any of the large convenience store operators, obviously that's a big portion of my business, so I do that. But they all did take a hit on the fuel side last year because people were not traveling as much. But they also saw a large uptick on their inside sales, especially with folks who weren't wanting to battle a crowd at a grocery store and only needed a couple of products. They might need some milk, bread, whatever it might be. It was a lot more convenient for them to hit the local C-store, grab what they needed and get in and out quick. So C-stores saw a large uptick in their point of sale, the average sale, I guess, on per transaction on the inside went up while fuel sales lagged. Now, again, fuel sales, as people are getting more comfortable getting out more, those fuel sales are picking back up, but inside sales have remained strong as well.
Right. And in terms of we're kind of getting close to wrapping up here, but one last question that I had for you is kind of talk about real estate now. Having gone through, and still in the midst of a pandemic, but we're looking at low interest rates. How are you seeing investments now versus like a year and a half ago?
Yeah, I think one shift that we've seen is that people are again more attracted to that stable, strong tenant, long-term leases. There's a couple of things that I think are on the horizon that are some concern for investors, and one is what happens with 1031s. How does that affect your choice of investment? Now, why I say that is historical investor that might say, I want to buy a distressed asset, I want to improve it, and I want to flip it. That might not be as attractive if you're not able to 1031 those gains into a new asset. If you're having to pay that large tax bill, it might not be worth the risk to do a buying that distressed asset and looking for that flip and large gain. It might be that's too much risk. I want something that I know I'm going to hold on to long term because I don't want to sell it, because if I sell it, then I'm going to have to pay the tax. So we have seen a shift in investors in looking at something, assets that are more stable, that are stronger tenants, and that are more long-term holds with some of that fear in mind. The other aspect is taxes. What are tax rates going to do with the current administration? Obviously, we've had this pandemic. We've had a record number of government spending in order to help us get through the pandemic. At some point, those monies need to be recaptured by our government, and obviously, the way that they do that is through taxes, and that's going to be ordinary income tax, and it's going to be capital gains tax. And so, investors are looking at that aspect on what's my tax rate today? What's my cap gains rate today? What is that? What do I think that's going to be down the road? And that's affecting their decisions. Some folks, as I mentioned, are looking at, I need to put my money into something that's long term, and I'm going to sit on it for a while, and I'm not looking to flip out of.
Right.
I had some folks at the end of last year that said, hey, I would actually rather sell now. I'd rather pay my cap gains today because I have a fear that down the road those cap gains are going to increase, and I'd rather pull my money out now, pay the tax now, and reset my basis in real estate.
Mm-hmm. Yeah, lots of things to happen in the future. Well,
and if we just had that crystal ball, so we knew exactly what was going to happen.
I know. Well, my crystal ball says people are going to break out of their houses in about April, May, and the world is going to open back up. That is my prediction. All right.
I love it.
Yeah. So actually, I think we're going to wrap up now. Let me just put some information here on the screen. And So if you do want to talk to Tyler some more about any investment properties he has, or if you want to talk to myself, this is both of our contact information. We appreciate everyone's time and take care.